All right. Here we are again, ready to take off on the morning bell. My name is Lan Turner. Happy to be with you. Let's get this baby rolling. We've got 5 minutes until the ponies are let loose. Up in the upper left-hand corner, we have the S&P 500. In the upper right-hand corner, we have the Dow. Bottom right-hand corner, we have the NASDAQ. And in the bottom left-hand corner, we have the Russell. And we're going to watch today. We need to go over and check out the news. Gary is in the house asking questions. He's like, "Good morning, Lan. Nice to see you this morning, Gary." Gary also has a question. He says, "What is your favorite economic calendar?" Steve's here saying, "Good morning. It's nice to have you guys here. Let's go look at the economic calendar and we'll answer your question, Gary." I like to use, if you can see it here, hopefully this YouTube projector thing is working. Let's come over here. The one I like to use is called tradingeconomics.com. So not associated with these guys at all, just like them. So they're good. Monday at 7 a.m. So the Fed Logan spoke this morning, 7 a.m. Fed Barr speaks at 7:15 or spoke at 7:15. And then we got Fed Jefferson speech at 11:30. So those speeches are over with. So I don't know if they said anything. We'll have to go look at the chart and see kind of what their consensus was. But that's my favorite economic calendar. And so that's what we've got going today. Not a whole lot after those guys get done talking. Usually they move the market a little bit because they're either a positive outlook or a negative outlook. Gee whiz. Great to have you, man. Had a good weekend. Yeah, had a good time. Pretty relaxing. Didn't do a whole lot. Thought I might go fishing, but then I didn't. Just went to the park and hung out with my puppy and my girlfriend. So had a nice relaxing weekend for sure. All right, let's get rocking and rolling here. We've just got, what have we got? We've got still got 3 minutes to go. So the couple of Fed guys gave their speeches and spoke, and the market looks like it's rallying a little bit off of that information. You see the Dow starting to go up, giving us some beautiful little flat bottom trend here in the Heikin-Ashi bars. NASDAQ starting to pull back a little bit, and it didn't do much. It kind of died on us. You'll notice that today I have down in the bottom right-hand corner, I have the micro mini NASDAQ. So not the mini NASDAQ. This is the micro NASDAQ. It's 10 times smaller than the other one. So let me draw you a dollar calculator just to show you. If we go from the peak of where this market's currently trading right there, bouncing off that 33,500 on the Dow, down to the low point, that is a $605 move in the Dow. And of course, if we come over here to the key, if you were to buy, if you were to have bought one contract of the Dow and then sold it at that 33,499, that would have been a $605 profit with our day margin of $750. So you'd only had to have $750 in your account to achieve that $605 profit. Let's see what that would have been down here in the micro mini. So from the 7 o'clock low right here to the high, that was $100. Okay, so in the full size NASDAQ, that would have been $1,000. But because this is the mini or the micro mini, it was $100. Now, the way you get to that different account is you just open up a different chart. You don't have to do anything magical in your account or anything. You just open up the micro mini NASDAQ versus the mini NASDAQ. And so if you come over into your charts and you say, show me the NASDAQ. So you pull up the NASDAQ and there's the NASDAQ listed right there. Right here. You can see you got two charts. You got the micro mini NASDAQ and you got the mini NASDAQ. If you trade on the mini NASDAQ, it's going to be 10 times bigger than the micro mini NASDAQ. So you have to decide which one you want. And depends on how much risk you want to take and how many contracts you want to trade and all that kind of good stuff. All right. Looks like the morning bell. There goes the ponies. They're taking off out of the chute. And let's watch for a minute and see what they do. Look at the mini Russell down here in the bottom left-hand corner. Again, this is the mini Russell, not the micro. The only one we're looking at this micro is the NASDAQ. The reason I switched that over is because the NASDAQ is so big, I decided to switch down to the mini NASDAQ on this one. Maybe we could trade this one with a little bit different strategies, see how things go. But right now, we're watching the the opening bell, and the Russell looks to be the leader of the group for the long side. He's really taken off. This is cousin Russell down in the left-hand corner. Now, remember, the way we look at this thing is cousin Russell. He's a little bit different than all the rest. We've got the S&P as a large cap index. We've got the Dow, which is also a large cap index. We've got the NASDAQ, which is a large cap index. Even though it's a micro mini account, it's just a smaller size of the NASDAQ index. Now, one thing I didn't mention is if you go back up here to the key on that micro mini, you'll notice that the initial margin is only $100. So rather than having to have $750 or $1,000 in your account like you have to have with these mini accounts, the micro mini, you only have to have $100 in your account. So you can trade with $100. So much smaller size. You can open your account with a much smaller size. Now, of course, over here in the futures market, we don't have pattern day trading rules. All right. So we're trading in the futures market through the Chicago Mercantile Exchange. This is not the New York Stock Exchange. When trading through Chicago, there are no pattern day trading rules. You can open an account with as little as $5,000 and trade long or short as often as you like, penalty free. All right. Penalty free. So, oh man, look at the Dow. Look at the Dow taking off. So Russell was the leader, and then the Dow took off and followed. The S&P is following. But look at the NASDAQ. The NASDAQ's bouncing down off that VWAP right now. It's tanking. So, all right. So, see what's going to happen. We're just going to kind of watch this for a second. Boy, look at the NASDAQ fall. Well, I like to do what I call porpoising. I like to see these markets porpoise. All right, porpoise. What do I mean by that? Holy cow, look at the NASDAQ tank. The NASDAQ's been doing good. It rallied really hard the last couple of days and made us some money. So a little bit disappointed to see it falling like this while everything else is taken off. The S&P will probably fall because we generally have a leader of the group, okay? And right now it looks like the leader to the downside is that NASDAQ. And so it's flushing down really hard right now. Usually, again, I like to see them porpoise. Porpoise meaning, of course, that they're all moving in the exact same direction and they're all doing the same thing. And that doesn't usually happen right out of the gate. Sometimes they're all over the place. And when that happens, that's a tough time to try and trade. Difficult to trade during that time. You want to kind of see them all doing the same thing and moving in the same direction. And then there's usually a leader that'll take off and all the rest of them will follow. And so you can trade the lagger, trade the one that's the slowest to take off when all the others take off. Of course, we have to keep in mind that cousin Russell over here, he does something different. So Russell oftentimes will not follow the rest first thing here in the morning. And then in the afternoon, he'll kind of kick in and they'll all kind of do the same thing again. So we're watching right now, trying to see if there's not an opportunity for us to get into this market and make a little bit of money. Right now in the morning bell, it's fun to watch, but it gets a little crazy. And so it's a little dangerous to get in here and try and trade first thing. If you guys want to give it a shot and go ahead and give it a try, you can jump into this mayhem and into the fray of the market right here on the opening bell. But it's a little bit difficult to trade. You can see that the market's all over the place over there on the S&P. Lots of topping tails, lots of bottoming tails, meaning, of course, that the market's in a serious area of indecision. So the S&P is not decisive at all. It's like, I don't know what the heck I should do. And then the Dow is being very decisive again. It was rallying hard before the bell, and now it's taking off even better. We had a little tiny pullback right here, right at the bell, and then it turned and started to rally once again. Same thing with the Russell. It had a nice run prior to the bell, had the little bell notification, had a couple of good bars, a big bar of indecision. That's called a clearing bar right there. There's an article in Pitt News Magazine about clearing bars. I think it's in the October issue, so that's the available issue right now. You can go learn all about clearing bars in the Pitt News Magazine. And then we had that pullback bar that stabbed everybody's long positions. Again, that's called a gunning for stops, and there's a gunning for stops article coming out in Pitt News Magazine in the November issue. So Claire Christensen is writing an article about gunning for stops. Oh my gosh, look at the NASDAQ. Holy cow. When the NASDAQ's going down and the Dow's going up and they're going in complete separate opposite directions, that's not good. That's not good. And then look at that S&P. S&P looks like it wants to break lower. That's called a flat bottom girls right there. That little flat bottom. See that how all those little yellow dots on the ATR, the average true range, are all going sideways like that. If it breaks and holds below that, it can break through it with those that stab at steely knives, just like out of Hotel California, right? Get the steely knives. Those little bottoming tails can stab down through there, but if it doesn't close below it, then it doesn't count. It's got to close below that yellow dot right there. If it closes below it, then we would anticipate a continuation of the downtrend, like this. But where it's not breaking and holding, it's using it as an area of support right there. And as long as it stays above it, we're going to possibly start to go bullish once again. So if it holds above it and doesn't close below those yellow dots, we'll start looking for a breakout to the upside. All right, so that's what we watch for on those. Now, the Heikin Ashi bars are kind of a different animal. All right, they're not the same as all the other bars. If we come and turn those off, I can turn Heikin Ashi off, and then the bars. This is what most people are looking at. This is what we call normal bars, and then so this is what everybody else sees. And then when we turn on our secret gaming codes, which is called Heikin Ashi, kind of cleans up all those bars. And it puts a smoothing component on the bars, and then it makes it easier to kind of see the trends. And so I like Heikin Ashi. It's a good tool. All right. So we've got Jim. Good morning, everyone. Jim says hello. And then, of course, we got Michael Bruce. Michael Bruce is in the house. Nice to have you, Michael. Good to see you today. We're starting to see the Dow is starting to roll off the top. So if you want to take the very first red color bar off the top of that reversal right there, you could. It could just be a clearing bar, give us a little top, and then it could continue out the top once again. So we'll be cautious and careful. Don't want to get crazy. But where the NASDAQ flushed like that, and of course now it's starting to rally. NASDAQ looks like it wants to start to rally once again. We could bring this thing in a little bit. There's your bracket. So we like to bracket the market, highs to lows. So there's our bracket. So that's the neutral market. As long as it's between those two white lines, this market is neutral. And then same thing here. We're going to mark this one here on the S&P. So there's neutral on the S&P. We got another line that's important down here. These are support areas that are going to show some importance if the market falls and breaks down. We also have a couple of moving average turned on here. You can see we got an exponential 21-period moving average and a 50-period moving average. I'll talk about those in just a minute here. But let's just keep watching these patterns. Now, there's your clearing bar. See that? Big clearing bar. Now, a clearing bar is a bar that where the topping tail cleared higher than the previous bar and the bottoming tail cleared lower than the previous bar. So that's a full clearing bar. Now, sometimes you'll get one that'll clear above, but not below, or you'll get one that clears below and not above, and it's clearing out the stops one direction, so that kind of has a little bit of a market bias to the other direction. But this was a full clearing bar. It went and cleared everything above, everything below, wiped out all the stops, and so what happens is generally now there's nobody in the market right there within that region, and so all the new traders stepping into the market are going to determine market direction. And since the flat first bar after the clearing bar is flat, that's a bullish trend. So we're going to anticipate a continuation of the uptrend once again here out of the top of this Dow, because that clearing bar had a flat bottom. Now they might reverse their minds and decide, I don't want to be long anymore. And then it could flush, but it's going to have to break below and hold below that flat bottom that came out after the clearing bar. So that would be a reversal clearing bar. There's one right there. You see the same thing down here on the Russell. One great big, well, you know what? It cleared all the stops to the downside, not to the upside, because it didn't break above the previous high. And then it started to rally once again. So that cleared out all the stops and starts to rally. That's bullish. That's a bullish pattern right there. And of course, there the market goes. Starts to rally higher once again over here on the Russell. So let's clear off those drawings, and we'll just watch these markets for a second. See if there's not an opportunity for us to catch a trend. Now, there's a number of ways that we can do this. I'll show you my little strategy. Let me move my face out of the way here. And so this is kind of what we're looking for. This is our trading strategy, and it's built, based on what we've talked about in the past. For those of you who have been in the class, we like to go off of this pattern here, right? The A, B, C, D pattern. So we're looking for a rally, a little pullback, and then a rally once again. Of course, on the downside, it could be a rally to the downside, a fall, a little pullback, and then a rally once again. But the longer term pattern of this whole thing, let's go back to this one here. This is the kind of the setup or the strategy that we're looking for. We're looking for a market that makes a reversal. We get what we call a pivot point, and then a market that starts to rally. We want to see those first 3-4 green bars to the upside, followed by the ATR signal. That's what we want to see. Then we want to see the market pull back, give us a little red bars, those clearing bars, come back, and then we want to see the first green candle to make a new high out of there. Watch that market rally. Sometimes you won't get red bars. You'll get the market will stay green. It'll start to rally once again. And so then we have that 50-period moving average in there. And as long as the ATR is above the 50-period moving average, we're going to only look for long positions. As long as it's below, we're only going to be looking for short positions of that 50-period moving average. That's why that moving average is in there. All right, so you guys want to take a quick screen capture of that, then you can. If you don't quite get it, I'm going to go back to the charts. If you don't get that screen capture, let me know, and we'll throw it up there one more time for you and let you capture it here in a few minutes. But that's kind of the strategy that we trade over here. That's kind of what we've been watching and the strategy that we've been looking for. So here we've got the market is topping out here. The Dow is kind of giving us some topping patterns. It's giving us pullback. Now, see, it's got to break and hold below those yellow dots. If it doesn't hold below the yellow dots, we won't anticipate a downtrend. We'll look for it to be a continuation of the uptrend. All right, so that's how it's coming into what we call a decision point. That's why we call it decision point trading. All right, so we got this little sideways trend going on here. Look at the Russell, or the S&P. Holy cow, that thing took off like a rocket ship. That's telling us that there's a possibility that this Dow could take off once again and go long. So we could drop an order in there to take another long position off the Dow based on the S&P rallying, based on the NASDAQ rallying, based on the Russell all rallying. Maybe we'll see that Dow follow. So we see that little pullback on the red bars and a continuation of the uptrend. Notice that we got the single red bar on the S&P. So the S&P rallied up. Now it's been weak. It hasn't been very good, but it's starting to finally show some strength now with that red bar. So there we take our first long position in the market. We're going to see if this thing wants to follow through. We're not going to take a big risk. If it doesn't just go immediately in our favor, we'll get back out. So we're going to put our stop in here to get out if we're wrong. And there's a couple of ways that we could do this. We could reverse our stop, say, hey, I'm going to take the downside slide if it wants to just reverse right off this decision point and go down. Right now, it's taking us long. We can go ahead and put our stop in there. Let's drop that in there. And I'm going to put that stop. I'm going to drop it right here. I'm going to show you something. All we have to do, it doesn't matter where you put it on the screen because you're going to program it. You're going to go edit, and I'm going to go trail on the ATR. Say OK. And it'll jump right up there to the ATR. And it'll continue to trail higher on that ATR dot. As long as the market's flushing back down, it didn't want to break above that previous high. That's not a good sign. That means that we could see this be a failure. See how it tried to go up there? It touched that, and it failed. And the reason it failed, it rejected that price, is because as it broke above that red bar, it went up there and touched that price. A lot of scalpers just took their profits right there, and more buyers didn't step in. It didn't break higher. So now it's showing weakness in the market, and we might just get stopped out, and this market could reverse. If it does, you could take a reversal position and say, well, if it's not going to go up, then it's going to probably go down. And you could take a reversal position and take the downside slide in anticipation that this market would flush out the bottom. The worst thing it could do is nothing, where it could just sit there and now bounce back and forth and go sideways, breaking higher, breaking lower, breaking higher, breaking lower. That's where you lose your account. That's where you lose a whole bunch of money, and then you feel bad and you have to come back in an hour or two and try and recover. And that's what we had to do last week. If you remember, I got down pretty seriously. I think we got down $1,000 in the opening morning bell session, and had to come back an hour later, and it took me a little bit of work to bring us back to green. I'll bring that spreadsheet up here and show you where we got to. Now the other markets are still rallying. This stupid Dow had such a good morning. Holy cow, what a beautiful morning. That was a pre-market session right there. And then it had this nice rally here. And now you'd think it would continue to rally with the rest of the market. Everything else is taking off. Look at the S&P, look at the Russell. Even the NASDAQ's recovered all the way and breaking out the top. Now, of course, once we get in, the stupid Dow decides it wants to go the other direction. Oh, my goodness. That's Murphy's Law. So our first entry to the market failed. So we were looking for that little bit of a pullback and then a continuation of the uptrend, and it failed. Came down and broke below the blue lights, or the yellow lights. Now, it hasn't closed below the yellow lights. We had our stop on the yellow lights, and I made it a reversal stop just in case it did pop down. It would reverse our position and take us short. So we're now short 2 in the market. And it doesn't want to flush either. It looks like it's holding solid. Yeah, I really want it to close below those yellow dots and give us an arrow to the downside and be the leader. We need it to be the leader to the reversal now and to start to fall. The NASDAQ is falling, wants to fall, or at least pull back a little bit. We're getting red bars on all the markets, but it's not decisive. I want it to be decisive. If it just doesn't decisively move in my favor, that's a disappointment, and I want it to fall hard here. If it goes and breaks back higher and starts to rally, I'm just going to get out and have 2 losers in a row. That's a serious disappointment. There it goes. Now it's starting to fall a little bit, coming back. Have patience, Lan. Sometimes I don't have enough patience. I jump in and out of the market too quickly, and just as it starts to work for me, I'm like, well, I took a big loss, so I'll jump out. Oftentimes I like to recover, and that's a good strategy. I get very passionate about that. I really think you should work towards recovery. So we've hit recovery already. So we're at 170, we're down 95. So we've hit recovery. Let's see if this market's not going to continue lower, though. We got 2 contracts right there. I'm going to buy one back. Okay, and that's going to bring me back to break even. And now I'm going to put my stop at break even right here. And now we don't have to do anything but wipe the sweat off our brow, and let's see if this market will continue to fall. If it comes back and stops us out, well, we'll be back with a scratch trade. We won't have any profit, but we've recovered our loss. So that's called scalp and trail. That's the strategy that I'm executing right now. And it looks like that might fail. Look at the NASDAQ is starting to rally hard, which could potentially pull our Dow back up and stop us out at break even. And if it does, well, we'll be at 0, but we won't be negative. So that's why I call it scalp and trail. So I went short with 2, and we were down a little bit of money. So then I pulled off enough money to cover my loss, and I still have 1 contract short. That was a reversal strategy, and this thing's going to come back and stop us out. Look at the other markets. They're all rallying. The Dow's going to probably follow. We'll give it 1 more second here. We could lock in 50, 60 bucks, but we could just let it ride too and see if it wants to fall once again. It's down there bouncing off that 21 period moving average, which oftentimes is an area of support. It's hard for the market to break through that and continue lower, so it'll oftentimes bounce on that 21 period moving average and rally once again. As we continue to trade and as we work through these different strategies, we'll add more features and tools into our trading strategy. We'll start using more automation. We'll start making things a little bit more complicated. But right now, my class that I've got going at the university is the beginner class. We don't want to get too crazy with you guys. We just start you off easy and gentle. Now we are going in the opposite direction. Look at the NASDAQ is rallying and the Dow is falling. The S&P is rallying. It's not generally a good situation to be in. We're getting a little bit of a shelf right here. You see this little pattern up here on the Dow. It's starting to make a little shelf right there. Either that's good for us to the downside because if it breaks that shelf, it'll continue to fall. Otherwise, it could break out and start to rally once again. That's a little pennant formation. I call them shelves because they look like little shelves, but it's a pennant. You can see it's coming to a point. That's another decision point. We call it decision point trading again. And so at this point, we're going to anticipate, because we're short, We want to see that market fall out the bottom, at least come down, test that 50-period moving average. Come down, there's the VWAP down here. Remember, the VWAP is like a rubber band. It likes to pull the market back to the rubber band. VWAP, volume weighted average price. It's just the average price of the market, but it's influenced by volume. So they call it the volume weighted average price. It acts like a rubber band, and the market has a tendency to bounce back and forth across it in a weak market. In a strong bullish market, it'll stay above that VWAP and never come back and touch it. In a strong bearish market, it'll stay below that VWAP and never go above it. If the market goes back and forth across that VWAP, you've got kind of a neutral, lousy, crappy market. Okay. So the NASDAQ is showing that it's a bit of a lousy, crappy market because it's just swinging back and forth towards that VWAP like a little rubber band. So it's starting to fall now. So that's a little bit good for our position. If that can show some weakness and breakdown here on the NASDAQ, that could push our Dow down. So we are not trailing at this point. I haven't got my stop trailing. It's still at break even. I'm going to go ahead and I'm going to tell it to trail on the ATR. So it's going to turn that over to the computer, and the computer is going to trail that for us. I don't have to do anything. I just have to let it go. We're barely sitting at $100. We've been at $100 profit on this thing 2 or 3 times. Oh my goodness, look at the Russell. Holy cow, look at the Russell. Is Matt in the house? There's Matt. Hey, Matt, are you trading the Russell? I know you got a little pension for trading that Russell over there. Wondering how you're doing. Are you doing the Russell today? So let's see if that Dow won't follow and come on down. Come on, Dow. We only got one contract. We're being real careful. We're being real cautious. We're not jumping in with big positions. There's always the question that you have to ask yourself. Is it better to take a larger quantity size initially and just take a quick scalp, which is a lot of people do that, which is what causes these markets to kind of fall. Causes these markets to kind of fall and then pop right back. You'll notice that when you get these patterns that we're talking about, where you get the first green pattern to break a new high or something, the market it'll pop and then it'll die. And that's because scalpers are doing that exact strategy. What they're doing is they're getting in with a large quantity, and then as soon as it moves in their favor, bam, they take them all off and they make $500 and they're happy for the day. So you get 1 or 2 of those, and then that's all you have to do, and you're good. So a lot of guys will trade like that. It's called scalping. They're not looking for a trend. And then day traders, a little bit different. Day traders are looking for a trend. They want to get into the market with a smaller quantity initially and look for a longer move. Now, what's the advantage and the disadvantage of that? The advantage of a larger quantity is that the market doesn't have to move very far and you can make a big bunch of money. The disadvantage of that is if you get in with a large quantity and the market does, and it fills your order and doesn't immediately, move in your favor and flushes against you, you lose a lot of money. So you have to be really, really confident on your positions where you're at on the beginning trade. You have to be very careful and cautious about what positions you take, because if you're going to get in with a large quantity, you could get in trouble really fast. That's the advantage and the disadvantage of scalping. So what's the advantage and disadvantage of day trading? Well, day trading is that we're going to look for a longer term trend, but we're going to get in with a smaller quantity up front. The advantage of that is if we're wrong and it goes against us, we don't lose nearly as much money. The disadvantage of that is to make the same amount of money that a scalper might make, we have to catch a longer trend. And that's harder to do. Longer trends are more rare. We don't see big, long trends in the market very often. And so, that's the disadvantage. So you have the advantage and you have the disadvantage, and you have to just decide which is better. And a lot of people say, well, Lan, which is better? What should I do? Well, there is no right answer to that. It's not right or wrong. It's just different. So it's what you feel more comfortable doing. Now, if you went and read the Pit News magazine for the October issue, David Duty was featured on the front cover. He's one of our trade mentors. He's one of my partners. And we just got stopped out with a $65 loss. So now that market came back. It broke those yellow dots. We were trailing on the yellow dots, so we didn't get as big, long downtrend as we were looking for. The Russell gave a lot bigger downtrend. Had we been trailing on the Russell short, we'd still be in that market. But we took the Dow short, and it didn't trend down as long. And we had a smaller downtrend with a smaller quantity, so we only made $65. We had 2, and we scalped one off, so we did what I call scalp and trail. That's that strategy where we took one off to bring ourselves back to green, but we let the second one run. That was on a reversal, if you remember. So David Duty, he's been a position trader his whole time. He runs our live room. So at the Trade Mentors, David Duty runs the live room, and people go and pay him to sit and watch and trade with him. Now, look at that Dow. We could have reversed on that order and said we're going to take a reversal position instead of just getting out of the market. We could have gone long on that break because that's a first candle to break a new green high, and we'd be long that market right now if we'd have done a reversal. But I didn't. I was being careful and cautious, and we want it to close above those yellow dots. And on the first initial break, you don't know if it's just going to stab it with its knife with this little topping tail and then flush down again, or if it's going to actually hold above it. So oftentimes I won't get in on those first breaks. I want to wait and see if it doesn't hold above it. And then if it holds above it, then I want to see it kind of make that pattern that we talked about where we get a couple of green bars and then we get a little pullback. If we can get a little pullback, then we can anticipate that's a good place to enter and we can look for the rally once again. Now we got this area of resistance right up here that stopped the market last time, went up and touched that resistance area, and it bounced. So we'll see if it goes up and bounces off that resistance area and falls once again, or if it can break and hold above it. If it breaks and holds above it, that's a bullish indication that the market will probably rally higher. So we'll watch and see what happens. Right now we're getting some nice flat bottom green bars. That's really good. That's what we want. We're getting a little pullback. We got a lower high. Remember, the lower highs are decision points where we can get into the market. The problem is if it breaks above that previous high, the resistance level is so close that the market could just pop up a tiny little bit, hit that resistance and flush back down. So that's not a good buy signal right there if you want to take that, because you got too much resistance too close right there. And so anyway, back to David Duty. Oh, see, and then the bar it went up and broke it. So it didn't even pull back on this bar. We still got 22 seconds left on that bar. So David Duty, he runs our room. So our live trading room, you can go and join that with him, and he'll sit and trade with you live in the mornings as well. But he's always been a position trader. He's never really traded, day traded, and he decided that he was going to day trade. And so he kind of looked at the different strategies that we've been teaching here at Commodity Trading School or over here at Trade Mentors, and decided he wanted to start day trading. So he started experimenting with the ATR like we use here and different moving averages. And we've got range bars in track and trade. And if you go take my course called the Heisenberg Strategy over there at Trade Mentors, you can get the Heisenberg Strategy for free. And you can jump into that. And that's a strategy where we trade the Heikin-Ashi bars. And so David Duty says, well, if I'm going to day trade, I want to try these Lan's Heikin-Ashi bars, or not Heikin-Ashi bars. I want to try Lan's range bars. And he found that he liked the range bar 50. And so he wrote an article about how he likes to trade the range bar 50. And he put a video in Commodity Trading School, and he taught you his strategy. And he's having a really good success with that. And so we wrote an article, or he wrote an article. We wrote the article in Pitt News Magazine and published it, stuck him on the cover of the magazine so you guys could have his trading strategy. And that's his trading strategy is very similar to what we're doing here. Almost, well, no, I'm going to say exactly the same, but it's very close. He uses the ATR like we do, like I do. He uses the moving averages as a filter, but he uses the range bar instead of the 1 minute chart. And then he scalps. He doesn't day trade. So he's just a quick scalper. He just gets in with a large quantity of shares and it barely moves just a little bit, and he pops it right back out. And he's been doing that over in his trading room. He's been having a good time. If you want to read that article, swing by pittnews.com, get that magazine, and you can read his article. And he gives you all the settings, gives you a video and the audio, everything you need. We give you all the audio, video, and the settings for his trading strategy over there at Pitt News Magazine. It's in the article, this October issue, and you can pick that up for $1. And you can pick up the entire year's annual subscription service for $1, not just one issue, the entire year, 12 issues for $1 if you use the coupon code LANLIVE-$1. So use LANLIVE $1. You can pick up David Duty's We can pick up the October issue, which has a whole lot more in it than just David Duty's article. But David Duty's day trading article is in Pitt News Magazine right now. You can listen, read, and watch at pittnews.com for $1. $1 for the whole year. And then it's only $39.95 after that for a whole year. 12 issues for $1. All right, look, we got our break right here. Let's look at the Russell. Michael, let's see, Matt Baker, what are you doing? Look at this break right here. We got it held above, but it didn't decisively move in our favor above. So this is looking like a little shelf down here on the Russell. Little shelf on the Russell with it's a wedge formation is what we call that. So this would be an ABC. If it fails to break above and continue to rally, we'd look for this market to then fall. So that would be an ABC to the downside. So this is what we're looking for here. Now that's bearish for all these other markets. So this market's coming down. It's trying right now. The Dow is trying to break lower with that previous high. It's trying to break through there and go up. The NASDAQ failed that strategy right there. So you had the flat. See how all those yellow dots went flat? Like a machine gun. One row. It went up. It closed above it, but then it immediately failed. That was a rejection of price. We had another higher high right here. So that rejected that second level right there. And now it's flushing down. So we're going to expect it to continue to fall, probably all the way down to that blue light. So it'll probably come out, or blue line, all the way down to the VWAP. It's probably where that'll come. It's got a couple of areas it's got to break first to do that. But the first one is going to be those yellow dots. It's got to close and hold below those yellow dots. And then the next level would be to close and break below that B point, the low point of the previous low. That's called a pivot point right there. And then as it comes down, we would expect it to come down and bounce off and use that VWAP as an area of support, and possibly even continue down to that 100% projection or 130.9. Those are Fibonacci numbers. So on the Fibonacci scale, there's a lot of people who trade Fibonacci. And so Fibonacci is important to them. And so they would anticipate coming down to 61.8 on the projection. 100 and 130.9 is that Fibonacci golden ratio to the projection side. John Mackey received the Fibonacci book last week. Not bad as promised to send out December, even though I position trade a lot of great stuff in there. Now, I'm teaching a class at the university, John, on the on investing and position trading. And we use that book as that manual for that class. All that Fibonacci, Elliott wave stuff, the accumulation distribution model, the bulls and bears, all that stuff is used in position trading, long-term investing in the stock market. So it's all fractal is what we call that. Fractal meaning that it's meaning that it works on small time frames and large time frames equally as well. So it's all good for all time frames. So you'll be able to use it for day trading, and you can also use all that stuff in there for position trading and investing. Okay, the NASDAQ's already come down. It broke those yellow lights right there, just like we said we were watching, going to see the Russell do. So the NASDAQ's already done it. It came down and broke those lights, the yellow lights, flushed all the way down to the VWAP. So this NASDAQ is not showing any strength for us today. It rallied up out of that first break at 7:30 morning, just broke up a little bit higher, and then look at how ugly and sideways it went through here. It went really ugly and sideways, and then it finally broke and went decisively down off those yellow dots back down to the VWAP. Now, first thing in the morning, it came down, didn't it? It broke out, went down, it went up, went sideways, and now it's breaking down again. So it's very neutral at this point. There's no nice, beautiful, bullish trend like we had last week. So remember last week, holy cow, that thing was just on fire. So we had what was it that triggered that? That was the unemployment, right? Unemployment numbers came out. Non-farm payroll, unemployment things came out. We had some really good news last week that really fired these markets off. So I was hoping for a continuation, but we're not getting it. We're getting a blow off now. So remember, if it goes and breaks above the VWAP and then stays above the VWAP, we consider it to be a nice, strong, bullish market for the day. But when it comes back down and it falls back below the VWAP, we've lost all of our mojo. Okay, we're not in a nice, beautiful, strong, bullish, trending market right now. We thought we were going to be. The Russell took off like it wanted to be, and then it fell back down, made the ABC up, failed to break above those yellow dots and hold, and then it did the little flip-flop. Okay, so we got the up arrow and then suddenly a down arrow, so that's called the flip-flop. And down it's flushing right now like a toilet, coming down, tested it. Look how it's bouncing off that 61.8% level. It came down, it touched it, and started to rebound. So that 61.8 is an important number to the Fibonacci people, and that would be us. We're Fibonacci people. Call yourself a Fibonacci people. Okay, so we are Fibonacci people. We like the Fibonacci stuff. We trade Fibonacci and Elliott wave. Elliott waves, of course, are just the theory that the market moves in waves, 2 steps forward, 1 step back, 2 steps forward, 1 step back, 2 steps forward, 1 step back. We generally look for 3 of those when we're in a nice trending market. And so that's an Elliott wave. It's just a probabilities. And that's when you'll oftentimes hear me saying that's an X1A2, or that's an X1A1, or an X2A1, or X3A1, X3SA1. And we got these different numbers, or we got an A1 or a B1 or a C1, or we got an A1 or an A2 or an A3. These are all probabilities that are lined out in that book that John Mackey's talking about. And we use those both in day trading, John, as well as in investing. So we use the accumulation distribution model from the Richard Wyckoff theory a little bit more in the investing out when we're doing long-term investing in the stock market, for example. But we definitely use the probability numbers that are in there in that Elliott wave count, measure, setup, trigger, follow through strategy that's in that book. We use that for day trading as well. All right, let's get rid of some of these. Delete all arrows. And we're just going to watch. Now look, we're bouncing around the VWAP. So let's go ahead and clean up the Russell. I'm going to draw a line, a horizontal line of the Russell across the top. We got a horizontal area of support right there. It's trying to break right now. And the 730 bell was right in there. So we're going to put that other line right there, which is right where the VWAP's at. So same thing up here on the S&P. So we're going to come in here and we're going to delete all the arrows off the S&P. And let's delete all the arrows off of the Dow. And I know I hear people out there right now, Lan, why are you trading more often? You should be in and out. You're a day trader. You should be jumping in and out, in and out, in and out, in and out. How come you haven't made 1,000 trades by now? That's not how you day trade. That might be how you scalp. You scalp and you're trying to take these little tiny, little 2 or 3 or 5, 10 penny moves. You might do that with your scalping strategy, but that's a little bit more dangerous. We can scalp a little bit if we want to, but I prefer to scalp and trail. I prefer to wait until we get a really nice, beautiful setup on a strategy that looks like it. I'm not really fond of taking reversals. Okay, I don't like to get into markets just because it looks like they're going to turn and try and catch the bottom of a trend and look for the first green candle to make a new high and go. We can do that, and that's a strategy that's definitely in our little book here. So if we come over to our strategy book, you can see that we've got lots of little strategies in here where you can come in and you can take first candle. There's one called the shelf to the upside, right? You would come in, the first candle, break a new high, or kind of a reversal formation. We talk about those all the time. And so here's one right here. So this would be your Heikin-Ashi color change strategy, small risk, big reward, bullish. So the market's coming down and you see that first green candle that makes a new high. You'd put your stop order above that green candle and look for it to continue to rally. Now, you can do that. That's definitely a strategy that's viable. And we'll do that sometimes if we feel confident in the market. But usually for me, I like to, again, I'm going to go back to these patterns here. I like to see a market that's already moving in my favor. And then I want to see the little pullback. So I'll wait for it to rally 3 or 4 bars, the little pullback, and then continuation of the uptrend. Okay, so that's a little bit more of what I like to look for. So I like to see the market prove to me it wants to be bullish first, not try and get in on the very first bullish trade. Now, a lot of people do, and sometimes I do too, but right here in this class, this is a very conservative class because it's new traders, beginner traders, just getting into the market. So I'm teaching the class at university, and so a lot of our students are here, and I want to show you very conservative trading and not aggressive trading. So not that you can't take those first green candles to break a new high, you certainly can, but just remember it's a little bit more aggressive trade because it could be just a 1 or 2 green bars, and then it could turn and flush once again. And if it does that, that would be an ABC pattern to the downside, A, B, C to the downside, and you're taking a long position on that reversal. Now we've got our first arrow here on the Dow. So now that's telling us that there's the possibility. See, I don't like it to break above the yellow dots if it's going to be an ABC to the downside. If it's going to be an ABC to the downside, I don't want it to break above the dots. I want it to turn green, but not go above the dots. I don't want it to close above the dots. Then it would continue down. But now it's closed above the dots. So now we have to think of the market as bullish. And if we're thinking of the market as bullish, we don't want to take a down trade. So we could come in here and say, well, it was just a strong pullback to the upside, and we could drop an order in here to take a short position just like that, and we could take another short position off this market in anticipation of a break to the downside like that. Even though it broke to the long side, we could take that short position. But now we're in kind of a precarious situation. We have a bullish arrow, right? We have a bullish arrow right here, but yet we're short the market. Why are we short? Well, because we're looking for the ABC to come down. It just pulled back too far against that ABC pattern. Now we're looking for it to drop once again. Usually I won't take that. Usually I'll sit and wait for the market to either do that above or below those yellow dots and not go through the yellow dots, because this is showing too much strength to the upside. It broke the average true range to the upside. So why am I taking a short position? So that's kind of the thought process there. So, and we're bullish on the market. We could get the flip-flop, which is what we've been getting because this is kind of a weak market. So we could get a flip-flop where we get a little up arrow and then a little down arrow, right? So we'll have to wait and see if that's what happens right here if we get the little flip-flop. So we're taking a little bit of a chance to see if this market won't break below those yellow dots again and start to fall and go down and test that VWAP. So the other markets are looking to want to do the same thing. We got the S&P over here possibly coming down and testing that VWAP. And we were so far we're right. It's coming down a little bit. It's rejecting higher prices, and it's coming down. It broke those yellow dots now. If it closes below there, we got 36 seconds left to see if we made the right decision. But we got that. I got to get rid of that setting on those. See, it's rejecting the downside. It's coming down. It's stuck that little knife through there, and now it's coming back, and it's coming back against us. So the market's kind of being indecisive right here. I don't really want to take a reversal and try and go long right here, even though we've got a bullish arrow. Well, I guess we could. The market's just slowed way down. It's just kind of died on us. So we'll drop that in there. Notice that I'm all using automated tools. This is the difference between free charts on the internet and a trading platform. You really want the software to be able to have these capabilities to trade for you. So you're not trying to set up all this order stuff when you make these quick decisions. Suddenly you're like, okay, I guess I'm going to do that. Well, it's too hard to go in and enter, I want to buy 3 long by that time you do that, it's all over. So you need to have all these quickly pre-programmed into the system. And so that's why you have these drop downs with all these different trading strategies, as you can see here. So I've got a bunch of different trading strategies that we can do all programmed into these, and I can just pick whichever one I want, drop it down, select it, and then suddenly that button now does something new. Come down to number 3, and now that market does something new. Right now we're trading the strategy 1. So you can see on all 4 buttons, I got number 1, number 1, number 1, number 1. If I want to trade strategy number 2, I drop that down to 2 here. I'd go down to 2 here. I'd go down to 2 here. I'd go down to 2 here. Now I'm trading strategy 2. All right. But right now I want to just all be on strategy 1. So we'll put them all back on strategy 1. They're all programmed in to do what I want. And right now I just drop that in there with a reversal order, quantity 3. and I'm looking for the market to continue to fall. If it'll continue to fall and close below those yellow dots, that's what we really need it to do to make this strategy work out for us. And it's just the market's just died. And look, all the other markets are going green. So at this point, because all the other markets are going green, I'm not going to take the chance. I just cut my position right there. There's no reason to wait for it to stop me out. All the others are going green. I could have, I guess, because we had a reversal order in there, but I didn't really feel comfortable doing that. So I just cut it, let it go, and we'll watch and see if we're not going to get a better setup, a better opportunity. So that cost us a few bucks, but nothing serious. We're still green, $50. That's really nothing in these markets. The markets have slowed down so much. We never really trended higher. We kind of created that little bracket in here you see on the Russell where we went up and created these highs. And then it came back down and tested the lows. Now it's just kind of going sideways. The market's not really strong for us today. And what you need is a strong market. When you're day traders, you want strong markets. And so, unfortunately, the last couple of months have been a little bit difficult to trade. So if you're learning how to trade in the last couple of months, I'm going to be honest with you, it's been a little bit tough. And so we've had some good days where we've had good runners and where the market broke its signal and took off. And if you were there with it, then great. But we've had a lot of these, markets where we just kind of bounce sideways with a lot of indecision. And so if you've been trading the last couple of months and you're just learning and you're like, I just can't make this, I just can't catch a trend. It's not you. It's not you. It's the markets. The markets have been really crappy. So we've been struggling a lot. The economy's not been doing well. We know interest rates are really high. It's forcing these big companies haven't been able to borrow money and grow. So their stocks haven't been rising. We've been having some pretty rough earning times. So because we're doing the indexes, we're, working with a lot of stock market indecision right now. And so what we oftentimes do is we'll go look at the longer term charts. So we can come out here. You can see it right here in my charting tab on the right hand side. I'm looking at all 1 minute charts. We can come in here. I've got a portfolio set up, and I'm just going to go into the daily charts. We'll go look at the daily charts, and you can see that even the NASDAQ's a real good example of that. These are daily charts, meaning that each price bar represents 1 day's time frame, open, high, low, close of the price for that day. And so, again, as we were mentioning to John Mackey about this, that we use the same theory out on the longer term charts. So we have longer term charts where we look at the same thing. So we're looking for the breaks, the shelves, the little falls in the market. But look, the last half a month, that thing's just been dead. Look at that NASDAQ. Lots of topping tails, lots of bottoming tails. Now we had some good runs here to the short side on the NASDAQ. See that? Lots of flat topping tails, flat top bars. So that was good to the downside. But this last couple of weeks have just been nothing. Look at how lots of topping tails, lots of bottoming tails, no decision, no driving force that's going to make that thing do something. Now over here on the Russell, it looks like we've had a nice downtrend, but we've only actually had a couple of really strong bars. The rest of them have been indecision bars with lots of topping tails and lots of bottoming tails again. Same thing here on the S&P. We had a nice little run to the downside right here as we broke below the nice little trend right there. Now, if we were to label these like we have in the book, this is the book that John's talking about. This is my playbook. This playbook is out on Amazon. If you'd like a copy, it's 260 or 280 pages of different types of strategies and probabilities and setups. There's lots of chart examples in there showing you how we use the count, measure, setup, trigger, follow through strategy, and what we count, what we measure. And this is, of course, if you just go to Amazon and search Lan Turner, you can pick up that book. All right. So what we're seeing is, if we wanted to label some of these things, we're coming in here. This was our first label. Let's bring this S&P full screen. So this is our top right here. This is the high of the market right there. This is our second top, right? So that's an ABC pattern to the downside. And again, this is daily charts. And so what you're looking at is you're looking at the same thing we've been doing on the 1 minute charts, right? Now we've got a little bit of a cheat code on here. This is called the bulls and bears, and it's telling us the markets is when in the market's bullish, bearish, and neutral. I like to use this on my longer term charts, and then on my daily chart or my 1 minute chart, that's where I like to use the Heikin-Ashi bars. Of course, I use Heikin-Ashi bars out here too, but I like to use the 1 minute chart with the ATR setup. And then this is coming in here with this A, B, C, D, and notice that we're coming down here. What did we call this? 130.9. We called that the golden ratio, right? So this market has gone A, B, C, D down to the golden ratio 130.9. If we were to label these, we would come in here and we would label this right straight out of the book. You can go get these. This would be an X1S A1. All right, so that's the label. That's the probability of what that is, which is a real low probability of success. And you can see it rallied and it failed because that's what we expected it to do. It made this little shelf right in here, this little break. It broke right here, broke below the low, and down it went. So that was our first break. And then their second break was that B line all the way down to 130.9, which is the Fibonacci projection golden ratio. Okay, it hesitated at the 100% level, but then it did go down and hit that 130.9, which is Fibonacci's golden ratio. And so now we're coming down here. And so if it's rallying, going to break up higher here, what are we going to anticipate? Well, this would be X2S A1. Why is it X1S A1? Why is it X2S A1? Because we're looking for the first drive down. Okay, so the first drive down, this is the A drive coming down the top. And then this would be the counter trend of that. And then this would be the B drive. So the A drive, B drive. So X1 is your exit to the A drive. So it's your first exit. So exit 1 to the short side, but it's your first A1, meaning the first long position to the upside, which is why it's a probability which is really low. I know it sounds like we're talking gobbledygook, but we'll take you through and teach you that in video, and it's not that hard. It's really quite simple. We just have 3 drives up: A drive, B drive, C drive. We have 2 drives down: A drive, B drive. So X1S A1 is the first exit to the A drive coming down. So this is your A drive coming down. This is your B drive coming down. So X1 is your first exit on the A drive down. A1, the reason it's A1 is because it's your first A1 going up. So if this market was to just turn and take off and go up, that would be your A1. And then if it pulled back and then rallied again, that would be your B1. Okay, so S just means short. We're talking about the short side. I know it's a little crazy, but it's all lined out in the book, and we'll talk about it a little bit more as markets go up instead of down, and it makes more sense. I know a lot of people like things going up rather than down. They see them a little bit more clearly, but this is coming down, so it's a little bit backwards. All right, so that's what these markets are looking at, and you can see the same thing over here on the Dow. So we had our A, B, C, X1S, A1, and then the market dropped all the way down to the Fibonacci 130.9. So what does this tell us probability-wise? Well, it means that we're going to should anticipate another rally, very similar to this one here. This drive here should be repeated, and we just take that drive, and we'll look for it to be right there. So we'll have 2 of them to do the same thing. It should come up and break those blue lights. And then it'll probably make a little ABC like this. This is what we're going to anticipate. Oh, let's go back to that Dow. So we're going to anticipate an A, B, and we want to see it hold. We don't want to see it break below that low right there on this pullback. We want to see it hold above that low and then start to rally once again, and this would start our accumulation stage. So if we come in here and actually turn on our accumulation model, CMF, you can see that we're down here in the buy stage. That's why that's green. This is the buy stage for large institutions. Large institutions start buying down in these low regions. They're accumulating their positions in anticipation of a market reversal and a rally in the market. So if you're trading on a longer term time frame, this is where you start accumulating your shares. This is where you start buying up in anticipation of the rally. That's why that's green down there. All right. Easy cheesy. So let's come back over to our 1 minute chart, take a look and see what's going on over here. Let's bring up all 4 of them. Okay, so it broke. Look at this. While we were off talking and having a little lesson on Fibonacci and Elliott wave and long-term charts, this market broke higher, came up. It gave the little flip-flop, though. See that little flip-flop? That shows weakness. There we had a little pullback. I got to go in and fix that. I got my preferences to say snap. I don't want that turned on. Save. Okay, back to the charts. Okay, so see that little pullback there. So we had our first rally. It broke above the yellow dots, pulled back, made the red bar, and then the first green candle to make a new high above that first rally bar. That was our signal for entry. It's pretty weak. It's not really strong. Made a little flat top right in there, and the market just kind of went sideways for long. It kind of broke above it, failed, came down, made the red dots, turned bearish, but then it turned bullish once again, and it's starting to rally. It's coming up here, testing this previous high. Look at it test that high right there. So now, given that the NASDAQ is doing that, what are the other markets doing? What can we look at and anticipate that the other markets are doing? All of them are doing basically nothing. They're all just kind of sitting here dead, not having a lot of fun with the market today. We may have to come back at, there's no other news. We looked at the economic calendar. So the economic calendar says that's it. Oh, I guess we got Fed Jefferson speaking at 11:30. So we could come back at 11:30 and see if he moves the market a little bit and gives us an opportunity to get into a trend. See if he'll trend the market. But for the most part, we don't have anything. And tomorrow we got no big move either. See the impact. If we just look at impact of 2, look, tomorrow we got really nothing. The Fed speaks again. They must be having a party because they're speaking today, they're speaking tomorrow, but they're not changing anything. They're not changing we don't have any anticipation that they're going to raise interest rates or anything. And then Wednesday, look at these guys. They're speaking every day, Monday, Tuesday. Are these guys up in Jackson Hole having a party, spending all the taxpayers' money or whatever? I guess they don't spend the taxpayer money, do they? Because they're an independent organization. They're not even part of the government. But we do have FOMC minutes coming out at 12 o'clock on Wednesday. That's going to move the market. PPI momentum, 6:30, that's red. That's going to move the market. Those that are marked in red, really going to move the market. They're highlighted in these that are highlighted in bold. They generally move the market. So, and then look at Thursday, core inflation rate. That's 6:30 in the morning, so an hour before the market opens. For us, 6:30. This is Mountain Time. And then another on Friday, we have another Michigan consumer report. You know what's funny? They always mark that as red, and it almost never moves the market, that Michigan consumer sentiment. Sometimes it does. And then going back into next week, those are all the big reports for next week. So our big day is going to be Wednesday, where we got a couple of big movers in there. But tomorrow might be around with the Fed speaking a little bit. We might get a little bit of action. But usually those guys are more, unless they're giving us some definitive good news on the markets, they don't really do anything but just the market kind of jumps around a little bit, and that's about all it does. So it's when they raise or lower or indicate the direction of interest rates that we get some good moves out of this thing. Stu's asking if this is a normal trading day. In today's normal trading hours. Is today normal trading hours? Normal trading hours? Well, the market opens. Let's talk about that just for a second, Stu. We're in the futures market over here, looking at the futures market right now. And so the futures market actually trades 23 hours a day. If you come and look at the key, it comes in and it tells you that the open time is at 4 o'clock p.m. Mountain Standard Time, and it closes at 3 o'clock p.m. Mountain Standard Time. So these markets, these indexes in particular that we're talking about, these indexes trade 23 hours a day. So you can trade, one of the guys at the office likes to go home and after work and watch a movie and trade while he's watching a movie. He holds his laptop on his lap. I used to do that and sit and trade in the evening after work. And you can do that because the markets, they're going to be a little bit slower, but that's good for a lot of people, right? They don't like really fast moving markets. They prefer something a little bit slower. And so the market's a little bit slower in the evening, but you can still trade them. You get the same signals, and you can trade them 23 hours a day. But that's the indexes in the futures market. In the stock market, you actually have an open and a close to the day, right? It's 9:30 p.m. or at 9:30 a.m. Eastern. Columbus Day today. Yeah, the markets are open today. They didn't take it off. So as being a holiday might also be part of the reason why it's a little bit slow today too. You're right. Forgot it was Columbus Day. I checked on Friday to see if the market was going to be open today, and they said they were. And I was like, well, it'll probably be a slow day because it's a holiday. So a lot of guys will take it off and not go to work, even though it's it's a working holiday for the stock market. So, oh yeah, I forgot about that. Thanks for reminding me, Stu. But there again, back to what we were saying, these markets trade 23 hours a day, but in the stock market they don't. They only trade from 9:30 in the morning until 4 o'clock in the afternoon. Now they have your pre-market session, which trades for a couple hours before the market opens, and then a couple hours after the market opens. But the futures market opens right back up at 4 o'clock and trades all the way until 3 o'clock in the afternoon again. So a little bit of a different type of game that we're playing over here in the futures market. Again, in the futures market, I'll pull that up and run that banner for you. You can see has no pattern day trading rules. So you can day trade over here without worrying about having to have a $25,000 account, having your account shut down for 90 days if you day trade with less than 25,000 in your account. You don't have to have short penalties. You don't have to borrow to go short. You don't have to pay interest. You don't have to pay dividends if you're short when the pay of dividends come out. You don't have to do any of that stuff over here. All right, it's a different world over here in the Chicago markets, which is why it lends itself to day trading so well. One of the disadvantages, of course, the futures market is that you only have about 30 markets you trade. There's not 4,000 like you have in the stock market. Of course, that can also be an advantage. You'll notice we don't have a whole bunch of scanners that we're sitting here monitoring, wondering, what's going to move today? I don't know. I got to really be all nervous and worried about what's going to move. And am I going to be on the right stock? And I got 4,000 stocks I got to watch. And that's really hard sometimes to watch those 4,000 stocks. So you have to have scanners and all kinds of stuff to help you identify which stocks to trade that day. Futures market, where we've only got, a few things to trade, we don't have to have scanners. We just come in here and we say, well, we're looking at the indexes. That's pretty cool. What are they doing? Nothing. All right, well, let's come down here and look at gold and silver. So gold and silver, obviously commodities, right? So we can trade those over here. We can come and look and see what gold and silver is doing. Oh my goodness, look at gold. We should have been over here trading gold. What a beautiful market this morning. So it broke out first thing in the morning. It rallied up, had a little bit of a sideways trend right here. Broke out of that, stayed above the yellow dots, and took off and ran once again. So gold ran. So there's our drive 1, drive 2. It looks like there might even be a drive 3 in here. So we've got a little sideways channel coming in. There's a possibility this thing could make a decision. Look at the 2-minute gold. So this is 2-minute gold on the left side. This is a 1-minute gold on the right side. Down on the bottom side, this is silver. So we got the 1-minute silver on the right side and the 2-minute silver on the left side. So 2-minute, when I'm day trading, a 2-minute chart is my long-term chart. That kind of sounds funny to say, but long-term chart, that's my 2-minute chart. It's long-term. It's getting ready to, it looks like it wants to crack lower. We could take a short position right there in anticipation of the blow off on silver. So silver, if it broke below that red bar, it's a little bit weak right now. We'd probably want to see it make us 3 or 4 bars down and then a little pullback to prove that it wanted to be long. Right now we're looking at, this is the MACD. And if you remember in class, we talked about the MACD, and I said one of the nice features of the MACD is it tells you when you're on the front side of a trade or on the back side of a trade. So in this side where it broke above the zero line and rallied up, that's the front side of the trade. So this is the front side of the trade. Now we're on the back side of the trade, which means it's kind of bearish. And the back side of the trade, you have to be very careful because bullish signals oftentimes fail on the back side of the trade. Doesn't mean they can't rally. Certainly can. And right here, it's breaking above, it's holding, and now would be a good time to get in, but you are on the back side of the trade. You have to take that into consideration. But it's could be an ABC pattern here. We could be looking for this market to come up off of this first break here, A, B, little small pullback, and anticipate a continuation of the uptrend. So we would look for it to go and make a repeat of that pattern if it was an ABC pattern. That's, in this case, $350. So we would expect it to go another $350, would take it up to that 100% level. So right in here, it's breaking and holding above the previous high. That's good. That's bullish. And we could anticipate a continuation of the uptrend. So if it continued up from here up to 100%, that would be $200. That'd be a nice little trade if it would do it. But we are on the back side of the trade, so you have to take that into consideration. It could show weakness. So here we are on the 2-minute chart over here. We're getting that little flag formation. See that? Little pennant formation in that trend. We got the nice little break right here. This was a natural trend line break above those yellow bars, which is neutral on the 2-minute chart. That's the bulls and bears. That's turning the price bars red, yellow, and green. We talked about that in class. So now the market's starting to rally. This is a nice big green bar. Got the little flag formation on a break above the VWAP. Now it looks like it wants to continue to go higher. So that's gold. That's what we're doing in gold today. Starting to fail right here. Didn't continue. So notice at the top right there, got a little weak on us. So got a little weak right there. And down here on silver, silver's starting to pull back and make a little wedge pattern, little decision point. So it's on the back side of the trade. So we're not real thrilled about taking a long position, but you have to watch and see what it's going to do and decide if that's what you want to do. So that's gold and silver. What else? We got crude oil. We come over and look at crude oil. Now I've got, this is the daily chart of crude oil down here. I watched some analysts that I have a lot of respect for on the news the other day saying they still think that $100 per barrel gold is still in play, which is up here, gold, crude oil, black gold. So they think that that's still a good marker. And the reason they're saying that is because they're reading the tea leaves, right, of the Elliott wave. So drive 1, drive 2, drive 3. That would be your Elliott wave. So we come in here with our Elliott wave tool. So X, 1, 2, 3, 4, that'd bring you up to 5, and that would be your 3 drive pattern. Then you get your A, B, C coming back off the other side. I don't have enough room to draw it out there. Let's pull this out. Let's go ahead and do a little academic work here for a second before we sign off for the day. Because we've been talking about the Elliott wave and counting and measuring, let's do a little bit of that. All right, and I'm going to teach you a little Elliott wave theory here. So this is looking at crude oil from an Elliott wave standpoint. So our first area right here, this would be your A1. All right, very simple. It's the first break higher. You often miss this one because you don't know when an A1 is going to occur. You have to have hindsight on an A1. And then you have the market rallies up. And so this right here, this little first pullback would be the A2. So you're in the first drive, the A drive. Okay, so that's your A2. And then this little pullback right here, that's our next little setup. So that would be what we call A3. And we only generally get 3 of those, right? So we anticipate 3 of those before we get a top of the market and a reversal. So that comes back down. And this is where we get what we call the spider web. So you come in with a spider web, you go off this peak, and it's just a natural trend line that comes down. You're looking for the market to break the natural trend line. That's your first spider web. Your next spider web is where it's breaking the mathematical model. And then the third one, of course, is just the previous high. So it's breaking the previous high. So there's your spider web. Okay, and those are entries to the B drive. So this would be our B drive. So now we're going to come in here and label this. So this would be B1, like that. So we're in here with a B1. And now we're coming in our first break right there. So we got our next little break right there. So that would be our B2. And it doesn't always work out perfect. I mean, sometimes, you know, nothing's perfect, but, you know, you can do a pretty good job of anticipating that's the B2. Now we get the next break right here. This is our next break. And so that would be our B3. B3. So we're in the B drive and each fractal size, right? So we're looking for the the A drive with three breaks in it. We're looking for the major pullback. Then we're looking for the big rally once again, which gives us B1, B2, B3. Now we're getting the pullback. So what is this pullback? If an Elliott wave has 3 drives and the fractal waves have 3 drives, we're going to come in here and we're going to anticipate that this is going to be right here. This is going to be C1. Now the B drive is usually the largest drive. So the C1 sometimes doesn't perform as well as the A and the B drive. So we get a little bit more shallow drive on the C sometimes. So that would be C1 down here on our spider web. So we're just looking for a natural trend line break. We would then look for a mathematical trend line, breaking the mathematics of the ATR or the bulls and bears. Usually we do this with the bulls and bears. Bulls and bears are a lot cleaner, but I'm using the ATR at this point. So then we would have, then we have the horizontal, right? Breaks across the previous high. So that would be your spider web. Let's bring this one up a little bit, say that it breaks right in there. So then we would look, and that would be your C1, right? So C1. And then we would look for the same little thing. We would look on this drive, we'd look for a pullback and a pullback, and we would label those. That'd come in here, and this would be your C2. And then you would have in here, this would be C3. So this is just the A, B, C drive, and these are your probabilities. Now, the higher you get in probabilities, the lower the chances that the market's going to continue higher. So an A1 has your highest probability. The problem is you don't know when an A1 is going to hit, so you don't ever trade the A1s, or you rarely trade A1s. Because look back here. Look at all these A1s. There's an A1, there's an A1, there's an A1, there's an A1. They all failed. Finally, we had one that went, and then you trade the A2. So the A2 becomes your favorite entry. So you get in on the A2 and you ride that up, and you can add into the A3 knowing that you're starting to weaken out. You're going to not have as good a push above the A3. So you take that into consideration. Then you're going to look for the pullback. Then you're going to look for the next rally. So the B1 you can get into because you're already in the up drive. So, B1 is going to be a good drive. So you get in on that one, which can, you can decide how aggressive you want to be, whether you want to get in on the spider web on the first one or whether you want to get in on the second drive as it breaks the mathematical model. And then you want to see it break above the previous high in a continuation. Then you get into the B2 drive and then into the B3 drive. Now we're coming in, we're going to do it one more time. This is the C1, C2, C3. Then we start going the other direction, but now we have to start talking about the X's. Okay, and that's what we were talking about earlier. So we're going to come in here. This is actually going to be X1, all right? Very simple. It's just the first exit on the first drive. So there's your first exit. We call that X1. So you got A1, so the exit to the first drive, and then we're going to have X2. What's X2? That's the second exit. Not real complicated, right? This is the second exit because it's the second drive. And the B drive is the second drive. We could call that A1, but A1X, but that doesn't make sense. We just call it the first exit because it's the first drive. Because we have three drives, drive 1, drive 2, drive 3. So we call X1 is the first drive's exit. X2 is the second drive's exit. And then we would have an X3 up in here. X3 would be the next drive's exit. Okay, so now we have the next drive's exit up in here. So that would be your exit to the upside. Now we're going to turn around and come back down. Now an Elliott wave, if we come in with our Elliott wave tool, we call that X1, 2, 3, 4, 5, A, B, C, right? So that's what an Elliott wave looks like. And then the Elliott wave comes in here. And this drive down here, we call this A1S because it's the first drive coming back down off the top, right? So we call it A1S. So A1, and S just means short. So it's to the short side. And this would be B1S. And of course, you could have an A2 and an A3. You could have a B1, a B2, and a B3 coming down the other side. And that's why we come in here and we say that this right here would then be X1S, right? Because it's the first exit to the short side when it breaks and comes in here. So X1S. All right. Now, if the market, then of course, let's do the last one down here would be X2S. X2S. Now, the reason we call it X2SA1, and we call that the exit point, which actually I got these on the wrong side, don't I? Because we're coming down, we want the exit point to be on this side, like this. And then this one would be over here. So we're anticipating a rise in price. X1S. And we say A1, and we throw A1 in there, simply because if it did continue to rally up, it would be our first A1 to the upside. It'd be our new A1 right down here. But X1S A1 is a real low probability that that's going to happen because we've got to come down here and create our X2S A1. And then A1 down there is a higher probability. Now it can go down 3 drives and we could come down one more and then we'd have an X3S A1 down here and that'd be a full 3 drive pattern to the downside. That's more rare. Usually what we get is we get the A1S, the second drive, A drive, B drive coming down, and then the market usually kind of goes sideways a little bit in here with a little indecision before we start getting some more A1s coming out the other side. So that little indecision box right there after the market comes down would be this little box right here. So this little box right here is basically that indecision box before you get a new trend. Okay. So then we'd get another indecision box and a new trend. And that's kind of how the markets work. Now it's not, it doesn't always work perfectly like that, but you'd be surprised how often this occurs, because the big, large speculators, the big banks and hedge funds, they know this. They're the ones who gave it to us, right? We understand that this is how they trade. This is what they look for. And that's why down here on a smaller time frame, now this is done on a daily chart. That's why we do this exact same thing on a 1-minute chart. And you get these little tiny pullbacks right in here. We call them the little flags and pennants, right? And on a 1-minute chart, those are what we're looking to take and get into the market. That's our opportunity, our decision points for entry. And so it happens on a big chart. John Mackey, right? Happens on the big charts as well as on the small charts. So we do this on the 1-minute chart. We do this on the 2-minute chart. If you go through my book, I'll show you a whole bunch of examples on daily charts or on 1-minute charts where I've done that whole thing, where I've counted and measured just like that. And of course, this is where we come in with Fibonacci. Fibonacci is just a ruler. And we just measure these legs of the Elliott wave. So the first leg, we then measure the second leg, and then we measure the third leg, and then we measure the way coming down. We just measure how far we think those markets are going to go. And then we can measure from the entire top to bottom all at once and kind of measure that's where we end up back over here at the starting point once again. So it's all a dance that we do with the markets. And is it perfect? Not every time, but it works pretty damn good. All right, works pretty damn well, and that's how we trade. So that's crude oil. That's a daily chart. And I think with that, I'm going to let you guys go. And we will see you tomorrow morning, 7:30, bright and early, ready to watch the ponies break out and see if we can't put a trade or two on. Hopefully you guys did well today, make some money. I see Matt says he's up. Matt says he's up $530 on that, on the Russell. Let's go look at the Russell one more time with Matt. I'm going to drop over here to the 1-minute chart. So I know Matt loves that little Russell, cousin Russell down there. Says he's doing nice, doing well. So good for you, Matt. Way to go. Love to have you in the class. Appreciate you coming and hanging out with us as we continue to move through these markets. Okay, guys, take care. We'll see you tomorrow morning.